All right. How's everyone doing? Yeah, yeah. DRS numbers are down. Well, they're up, but the rate of accumulation of DRS shares has dropped significantly from the last reported interval, which was June 30th, 2022. This is ending October 29th, 2022, showing a net increase of 500,000 shares DRS. There could be a lot of reasons for that. Our economy is not the best right now. Um, People getting laid off, cost of goods has gone up significantly over the last 2 quarters. I mean, one large shareholder could have pulled out. There's a number of potential reasons. Um, it's still showing a net increase, but it's definitely slowed significantly. I will say that no large whale has sold off. If they did it very slowly because the relative liquidity on GME has not dropped significantly at any point except October 31st since the last earnings. And if somebody sold like 8 million shares or something like that, there would have been a huge spike in liquidity. I think EPS is about where I thought it would be, slightly up, but we're not beating expectations, which were revised after last quarter's surprise. Cash on hand is still good at $1 billion. Some of the SG&A obviously this quarter went towards refilling inventories into the holiday season, but the inventories, as you can see, a little lighter than last year, which is good. They're not overbuying. You don't want them to do that because it'll collapse margins into early next year. Free cash flow positive on the quarter. That's a very good sign. That means that this quarter the business was able to make more money than they spent. They're self-sustaining at least across this last quarter, which is very impressive. That could be a very good indicator going forward. SG&A is down. But a little up over last quarter. However, you see a reduction in SG&A as part of sales from 34.1% in quarter 2 to 32.7% of sales or of revenue as a percent of revenue in quarter 3. So that's pretty good. Sales are down year over year, but that should be expected. However, operating loss is also down. So, where they have sales have reduced, so have operating losses. Leases are down not only year over year, but leases are also down from the beginning of this year by about 50 million. So continued reduction in, costs. Dropping leases is good. They have a lot of stores that don't get a lot of business, so it's better that they're starting to concentrate and get out of those leases that are bleeding money. But overall, I think it's kind of within line uh, with what we were expecting. Yeah, I said flat earlier. I meant it. Um, we'll see what happens with the call. If they give some forward guidance, we could get some volatility here in the after hours session. But I think I think it's really good that we're seeing positive FCF. I think that could only improve in quarter 4, and is a good leading indicator that we may see positive earnings in quarter 4. So I like that. You'd expect them to short the stock, but with what liquidity? People will sell because DRS numbers aren't up. People will sell because the stock price hasn't been volatile in after hours. If you can't find liquidity up and you can't find liquidity down, why not make it boring and get people to sell that way? I'm still bullish on it. I think these are good numbers given the economic climate. They still have no debt. I still think they're well positioned to spurn a growth cycle moving into a deeper recession. hopefully in a more stable interest rate environment. But if they can expand their margins while their competition's margins collapse, they're in a very, very, very good spot. So I'm still pretty excited about that. I'm not selling. GME's not gonna buy back fucking shares. I'd be really surprised if they did. They only have $1 billion in cash on hands. Unless they took a loan to do it, which would be shocking. I'd be surprised if we get forward guidance. I think the most forward guidance we've gotten, and we'll probably get, was RC in that interview saying that they're going to focus on short-term profitability, and they need to. C-suite needs to get paid. They've been working almost 2 years now with the stock basically under their buy-in price. It's, if any long shorts on the stock, that's definitely a goal for them to keep that from happening. I'm not in complete denial, but going from an average of 15 to 20 million a quarter to 500K, that's a suspiciously sharp trend change. Could hedge funds have been pumping DRS to set an expectation and then rug pull? Sure. Yeah. DRS benefits volatility shorts. I could see them DRSing shares if they wanted to. Why not? It lowers the size of it reduces the size of the market, and it makes it cheaper to control the price of the underlying. So, with that increased volatility potential, it also requires less capital or energy to manipulate the price of the stock day to day. I don't think DRS was a Hail Mary at all. It's just a fucking giant waste of time. Computer share is the only people that got rich on it. They have FCF and $1 billion in cash. At some point, they have to put it to work. Yeah, now's not the best time to start another growth cycle. I think a lot of the expenditures so far have been in just turning the business around, and positive free cash flow is the first indication we've really seen of any kind of turnaround in the business since everyone bought in. So, I mean, that might single-handedly be one of the most bullish things we've seen on the stock since it ran to $400. But not gonna announce a share buyback. There's no way that benefits them. It's definitely not gonna get the shorts off the stock. Massive volume on SPY after hours is preparation for a straddle. Maybe. Yeah, could be. Thanks, Double Down. It's all about the numbers. Did the GameStop include a Teddy book review? And people are distressed about the DRS numbers, but look at the free fucking cash flow. Didn't any of you guys ever watch like DFV's fucking videos? DFV was all about free cash flow. Free cash flow and underpriced assets. That means that if that number sustains in the next quarter, that means no share offerings, right? That means the company's no longer on life support, it's self-sustaining. That's a big deal. Even if the market's not pricing it as a big deal right now. Still a big deal. It's fucking amazing how bearish people are who pretend to be bullish on this stock all the time. Fucking pores. Yeah. It's like, not enough members of my cult hid their shares in safety deposit boxes this month. Whatever will I do? Yeah, their cash reserves are, I mean, they have positive cash flow, right? So cash reserves are basically untouched. A little bit of expenditure on inventories, but that's expected. They're a retailer. We're moving into the holidays. We want to see inventories grow, right? You don't want to see them grow too much. Inventory's up about 230 million since the beginning of the year. So hopefully we see, the sales of those realized in the quarter four earnings. Yeah, these are official numbers. These are directly out of the 10Q. Call hasn't started yet. I've got it playing. It hasn't started yet. I'll open it up as soon as it turns on. Oh, fucking sex bots. I'll need to dig deeper into the earnings to see like sales from e-commerce, but I don't know if those have improved significantly. I hope they've improved a little bit. I don't think the um like distribution centers are up and running yet. Those leases only started in April. It takes quite a while to get like a big fulfillment center like that up and running and operating under OSHA standards. Even for Amazon it can take like 6 to 8 months. They have nothing but capital throw at it. Here we go.
Quarter 2022 earnings conference call. Please note that certain statements made during the call constitute forward-looking statements made pursuant to the safe harbor provisions of the Private Securities Litigation Act of 1995 as amended. Such forward-looking statements are subject to both known and unknown risks and uncertainties that could cause actual results to differ materially from such statements. These risks and uncertainties are described in the company's earnings press release and its filings with the SEC. The forward-looking statements today are made as of the date of this call, and the company does not undertake any obligation to update the forward-looking statements.
The
I will now
forward-looking
turn the
statements
call over to
disclaimer
GameStop
is always
CEO,
there.
Matt Furlong.
They
Good
say that in
afternoon,
every
everyone.
call.
I want to begin by acknowledging the dedication and focus of the teams managing our stores, fulfillment centers, and e-commerce platforms. As the holiday season begins, they are going the extra mile and working exceptionally hard to deliver for our customers. I also want to take the opportunity to acknowledge our stockholders who continue to demonstrate unrivaled enthusiasm and support. As we work to transform the company and do something unprecedented in the retail sector, that sustained passion is a major tailwind for us. Similar to last quarter, I'm going to spend some time at the outset of this call recapping where we've been, where we are now, and where we're looking to go. Throughout 2021 and 2022, we were extremely focused on repairing our decayed foundation, reestablishing a culture of operational intensity, and setting the right long-term priorities. This translated to building a strong balance sheet, modernizing a crumbling infrastructure, and putting together teams that are now able to operate with the nimbleness and efficiency our stockholders and customers expect. Today, we're in the process of aligning corporate costs to our go-forward needs after completing the majority of necessary upgrades to our systems, fulfillment capabilities, and overall foundation. A large portion of our cost cuts will stem from reductions in corporate headcount that have been made during the back half of this calendar year. In some cases, individuals who helped us complete key initiatives have left on their own accord and are not being replaced. In other cases, we've made the decision to eliminate or streamline parts of the organization where we can leverage the work completed over the past 18 months to operate with increased efficiency. We now have a firm understanding of the resources required to pursue opportunities in gaming, as well as high potential growth categories like collectibles and pre-owned businesses. Looking ahead, we have two overarching priorities: achieving profitability in the near term and driving pragmatic growth over the long term. Now that the necessary investments have been made and we have identified the aforementioned opportunity set, we're going to be very judicious with respect to how we allocate capital to the core business. Maintaining a sizable cash position will maximize our optionality and keep us strong against a challenging economic backdrop. If a strategic asset or complementary business becomes available in the right price range, we want to be able to explore those acquisitions. As a result of these steps and our planning, we believe GameStop is well positioned heading into 2023. We stand to benefit from our strong cash position, lack of debt, healthy inventory mix, shrinking cost structure, and disciplined focus on categories where we have competitive positioning. We are also fortunate that the company's exposure to digital assets has been very modest thanks to risk management efforts. The company has proactively minimized exposure to cryptocurrency risk throughout the year and does not currently hold a material balance of any token. Although we continue to believe there is long-term potential for digital assets in the gaming world, we have not and will not risk meaningful stockholder capital in the space. Let me now turn to our financial results for Q3. Net sales were $1.186 billion for the quarter, compared to $1.297 billion in the prior year's third quarter. Approximately $50 million of the decline is attributable to FX. Sales attributable to new and expanded brand relationships remained strong. Likewise, sales in the collectibles category remained strong on a year-to-date basis. SG&A was $387.9 million, or 32.7% of sales, compared to $421.5 million, or 32.5% of sales in last year's third quarter. Notably, SG&A as a percentage of revenue was down on a sequential basis from 34.1% in Q2 of this year. We've also taken additional steps in recent weeks to further reduce SG&A on a go-forward basis now that significant improvements have been made to the core business. We reported a net loss of $94.7 million, or 31 cents per diluted share, compared to a net loss of $105.4 million, or 35 cents in the prior year's third quarter. As with SG&A, we saw a healthy reduction in our net loss on a sequential basis versus Q2 of this year. Turning to the balance sheet, we ended the quarter with cash, cash equivalents, and marketable securities of $1.042 billion. We continue to maintain a strong cash position while sustaining strong in-stock levels for the busy holiday season. With respect to inventory, we have strengthened our position in recent months by divesting a small percentage of merchandise that was acquired late in 2021 and early in 2022. Divestitures occurred in categories seeing soft customer demand over multiple quarters. Inventory was $1.131 billion at the close of Q3, compared to $1.141 billion at the close of the prior year's third quarter. At the close of the reporting period, we had no borrowings under our ABL facility and no debt other than a low-interest, unsecured term loan associated with the French government's response to COVID-19. Capital expenditures for the quarter were $13 million, up $0.5 million from last year's third quarter. We anticipate CapEx will remain at similar or reduced levels now that the company has largely completed its period of heavy investment. In the third quarter, cash flow provided by operations was $177.3 million, compared to an outflow of $293.7 million during the same period last year. In terms of an outlook, we're not providing formal guidance at this time. It is worth reiterating, however, that our goal is to achieve profitability in the near term. I want to finish by reiterating what we've said in the past. We're attempting to accomplish something unprecedented in the retail sector. We're seeking to transform a legacy brick-and-mortar business that was on the brink of bankruptcy into a retailer that meets customers' needs through our stores, e-commerce properties, and emerging sales channels. This path carries risk and is taking time, but it is the path we are on. With that said, GameStop is a stronger business today than at any time in the recent past. I'll leave it there for this quarter. Thank you.
This concludes today's conference. Thank you for your participation. You may now disconnect.
All right, so the usuals, right? I don't know what people were expecting. We've had roughly 5 of the same exact earning call. Cash flow is positive. That's the thing to focus on here. Net inflow over outflow in the previous years is it's huge. GameStop made money this quarter for the first time in fuck, how long? What was the last time they had positive free cash flow? It's been a long time. Years, right? And in a recession too. No volume, yeah, just kind of flat. The DRS numbers are 71.8 million, up $500,000 or 500,000 shares from the previous reporting period. Yep, they're not going out of business, right? And there's no liquidity. So we're going to see some vol shorts cover sometime in the near future. That'll drive valuations up again. Maybe they'll stay there. They'll have a little more staying power. Flat always better than down. And they're gonna... So what GameStop's likely to do moving into this recessionary period is start to take capital and focus it on sectors where they have either little competition or their competition is pulling out of those sectors in order to focus on their core business plan. So remember, as we move into this high interest rate environment, companies with a lot of debt are going to be cutting a lot of corners, right? And these companies don't really have a lot of exposure to like Amazon, Walmart, Target, like these big competitors, right? They don't have a lot of exposure to video games. Video games aren't a significant amount of their net sales. Best Buy, Newegg, those, they may stay more in competition with GME because their focus in the sector is much more well focused. But the bigger competitors are going to be pulling out, and that gives GME an opportunity, kind of a unique opportunity, especially given their debt and ability to stimulate a growth cycle during a recession, the opportunity to expand in those contracting markets. And that's how you capture market share, right? And so if GME can capture a significant amount of that market share when the recession ends, they can be a market leader in those sectors, right? And you know, that strategically, that's a fantastic way for GME to grow. And ultimately, that's why we bought the stock, right? Because we thought it was worth more than it was being charged. Like, the value was greater than the price, right? I mean, don't get me wrong, the price has been exorbitant sometimes, but there's times like right now when the price is very much in line with the value of the company. No, my buddy told me to buy it. Welcome to investing. Who are they looking to buy? They didn't really say they're gonna buy someone. They've said that they have money for acquisitions like fucking 15 times now. MOASS is over, right? It was never a thing. I'm feeling good about my port right now. I'm only in stocks that have great long-term potential. None of that trading anxiety, pure value investing bliss. That's a nice place to be if you have a lot of capital already. If you don't, sometimes you have to make money other ways. I don't think they're going to buy any fucking ape. They have $1 billion in the bank. They got that money from us. Well, let's see what the realized value of it is once it's reinvested into the company. This was never going to be anything less than a 2 to 3 year hold, right? There's still money to be made on it. There's still a lot of, capitalization that can occur off of its implied volatility, which is still significantly high. Again, positive free cash flow, self-sustaining business, bullish as fuck. If you guys bought for MOASS, I mean, and still hanging, I mean, I don't know what to say. DFV didn't buy for fucking MOASS, right? It's a lot scarier to short a company that has positive free cash flow. Bought for MOASS, stayed for the FTX gift cards. Well, I'm going to keep my shares. You guys do whatever the fuck you want. If you sell enough of them, I can buy more. And if you guys want to learn how to make money on your investments, come hang out. We're a very hospitable, fun environment to be in all day. Yeah, I still like the stock. Cool. Yeah, some would say that. Thank you guys. I'll see you tomorrow morning. Have a good night, everyone.